This is TreppWire Week in Review for week ending May 15th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with our own Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And a first for us here, we're going to be talking with another one of our Trepp experts, Lonnie Hendry, during today's podcast to hear how property valuations are impacted by COVID-19. But first, this week, more and more of the U.S. is gradually moving toward reopening, and we're left grappling with what the new normal is going to be like for the foreseeable future. Jobless claims fell slightly again last week to 2.98 million, so the total tally of jobless is now slightly over 36.5 million. The markets declined sharply after Fed Chair Powell delivered a sharp warning about a prolonged recession and looked to Congress to do more fiscal stimulus. It's obvious that the investors don't want to deal with a prolonged recession. After the news this week, the market reacted negatively, then swung up Thursday. What's happening here?
Thanks, Martha. I think this has been a great week for transparency of data. Before that, I want to give a programming note that a couple of weeks ago, I was told I was 3 coffees deep by the time I started rattling off the data. So I'm going to go a little slower this time. I'm only 2 coffees in, but I'm also halfway through a big gulp. So that's probably an equivalent, but we'll try to go a little slower. But I think it was a great week for people to see what's out there, what servicers are going to do in terms of transferring loans to special servicing, how special servicers will deal with them, what percentages of rents are getting paid, what percentages of loans are being made, things like that. There's just so much data out there. We're going to try to run through it on a 2 coffee pace. We'll see how we do. Joe and Lonnie and Martha jump in whenever I'm getting over my skis too much here. But let's start with some pricing transparency. We've seen a couple of deals priced now in the CMBS market. The most interesting one we saw since our last podcast was the pricing of the MGM Grand and Mandalay Bay hotels in Las Vegas. Citi and Goldman combined to put that deal out. The BBB and BB classes, which were all that was sold out of that deal, priced at $83 and $77 respectively. That corresponds to spreads of 525 and 625 over the swap curve on 10-year debt, which I was shocked at the tightness of that. For 10-year debt on an asset class that is very much on the ropes right now, and how strong we come back is really a function of what the economy is doing 2 or 3 years hence. But good for Citi and good for Goldman for getting that thing cleared at a level which I think was quite respectable.
Yeah, I think that one was downsized from 2 billion to 500 million or so. And I think that there were some serious reserves built into it. So there was a little bit of comfort that there was enough reserves and not too much leverage, so that maybe the next, even if it's not so great for the next 6 months or so, you know, the lenders here or the bond buyers here feel safe.
Well, what it does is it gives anybody who's looking to buy or sell debt on hotels in Hawaii, New Orleans, Orlando, and so forth, at least a benchmark for where the market is today. And I think that was very useful in terms of transparency for that part of the market and allowing people to really feel like they know where things are selling at this point.
I will say that I've been saying it for the past 6-7 episodes, but we are consistently hearing that question from clients and non-clients alike is, you know, we're trying to mark our books, whether it's bond books or loan books, and having at least some sort of deal price in the market is useful as a, you know, a foundation start to trying to mark some of those positions.
Pivoting over to the retail segment, Commercial Observer was reporting this week that JCPenney made only 8% of its monthly lease payments in May. That was down from 96% in April. The report cites Datex Property Solutions for the data. The market is anticipating a bankruptcy filing from JCPenney this week. Rumors have it that 200 stores will be closed out of the firm's 800 or so footprint. KKR is said to be heading up a debtor in possession deal to provide about $450 million to JCPenney to get them through the bankruptcy process, although only about half of that is in cash. Some of it is make good. And basically that will flip their loan positions, which are sizable and have been trading at a huge discount, into equity. So that's something that touches upon the CLO market as well.
So here's a question, Manus, and maybe a dumb question. How did they decide on which 8% to pay? Right?
That's a great question.
I'm not going to pay 92% of my leases, but these 8%, I like that landlord, so I'm going to pay him one more month.
Yeah. It may relate to malls being open or locations being open. Maybe those they felt like they were obligated to pay, whereas at a mall that was closed, they felt like they had more latitude. I don't really know, but I do have a JCPenney not too far from me, and I may take a spin over there if bankruptcy is announced, just to speak to the rank and file and see what the vibe is with that. See if I can get a nice blazer at 60% off.
Maybe load up on some knee-high crew socks.
That's right, with the stripes on, like back when I used to play high school basketball.
That's right.
So a lot of people ask us, where is this JCPenney exposure on our website? We have detailed web pages on where JCPenney is a tenant behind loans, CMBX loans, CMBX 6 loans, and where they're non-anchor at a mall that may back CMBS. So that's been a real highly viewed part of our data set recently, and I think it'll be extraordinarily highly viewed once the list of 200 store closings comes out. Brookfield, in their earnings announcement, said that they had requested 12-month maturity date extensions on all of their maturing 2020 loans. That would be their mall loans, single asset, single borrower debt. So for anybody out there trying to trade this stuff, especially if you bought this paper at a discount, hoping that you'd get paid back in full in 4 or 5 months and make a home run, it's probably time to update your cash flow assumptions to assume that a 12-month extension is likely. If you have any questions about that, please ping Joe. He's available on Facebook, Twitter. I'll give you his text number too if you want it.
I've been off pretty much all social media for like 9 months. It's one of the best things I've ever done. I still read Twitter though, because I gotta see what's going on out there. Instagram, Facebook though, you can't find me.
I'm still doing a lot of Spotify. That's my thing. When I'm having a bad day, it's an old Allman Brothers show from maybe the 70s or 80s. They put a lot of those out on, release in the last few years. And if I need something to pick me up, it's a little Motown. So that's my recent go-to stuff.
I thought you were gonna say you've been spending a lot of time on MySpace or
me too.
or one of those.
I was afraid.
Hey, listen, I'm still a DOS guy.
Or maybe
right?
Fanny.
half our listeners don't even know what DOS is. Right? They probably think it's some kind of website or coffee brand. But yes, I'm still a DOS guy deep in my heart.
I grew up on DOS. I don't think I've ever seen a Windows Explorer on your screen in my life.
No. I still use the attachable headphones, and somewhere around the house is a cassette Walkman. Going to more broadly, at this point in the month, we've seen about 35% of loans report for the May cycle in terms of delinquencies. Quite a mixed bag out there. I'll run through it very quickly. The delinquency number with like about a third of the loans reporting right now is 6.4%. That would be up from 2.5%, give or take, last month. So a big jump, but not nearly as big as it could have been based on the number of guys that had missed their April payments. We thought that the number could get to 10% or more based on those April numbers. It's 6.4 right now. But Broward and Palm County still have to come in. They haven't reported their voter tallies yet. So we have to see how that looks in, as the week goes on. Hotel and retail are getting hammered. Hotel and retail delinquency, 16.1% for hotel thus far in May, 8.9% for retail. Watch list, the hotel sector, over 35%, retail 27%. Special servicing, Lodging is 14.5%, retail 8.5%. So if you sum up the loans that are on watch list or with the special servicer in the lodging sector, in less than 2 months, we've gotten up to 50%. Unbelievable. So hard to imagine that you don't see the vast majority of these guys looking for forbearances. And we'll see how that goes. Lastly, before I turn it over to Joe and Lonnie, we started to see some forbearances come in. We've seen about a dozen to 2 dozen reported so far. We write them up in our TreppWire here and there. Some are very detailed in their explanation of what's happening. One of the more interesting ones came from a Courtyard by Marriott deal, almost 600 million backed by 52 hotels. Most of the hotels were built in the late 1980s. The agreed upon forbearance pauses debt service for 3 months. Once that period is over, the borrower can repay that in the greater of 1/12 increments or all excess cash until the amounts are repaid. Contributions to a renovation reserve are deferred for 3 months. Those don't have to be paid back for another 18 months. The renovation initial completion date for that loan was pushed back by a year. From a cash flow and modeling point of view, what we've seen with these modifications thus far is the servicer will still advance during this 3-month forbearance process or period. And as a result, the trust and bond cash flows should not differ. And at the moment, other than anticipating when a loan might get paid back, there probably isn't any cash flow modeling assumption that the average user has to change yet to reflect a forbearance when doing their price yield calculations. The ultimate maturity date, yes. Whether you're predicting a default down the road, what the loss will be, right? All of that still stays in play, but you're not going to see a cash flow interruption for the next 3 months on loans that get forbearances.
So, man, it's just, for the less nerdy folks out there than us.
Nobody's less nerdy than me, dude.
Maybe not. Maybe, wait, is that like a double negative? So when we model that, right, into the cash flow model of the loan, whatever the principal and interest that's forborne, is that the word? Forborne, not paid.
Deferred.
Is that deferred? There you go. That would be, cumulatively taken into account in our ACERs or interest advances or other areas of the model, right? So like there is some portion of the model that's paying it back after the forbearance period, I would think.
That should be tracked. You would think that the servicer advance number would increment up every month and you would see it outstanding. It was believed that the loan would be considered current and you would use the paid through date to figure out if the loan was kind of implied delinquent or not. It seems to be a mixed bag with the data at this point. Right. Some servicers and trustees have adopted that, some not. I think it's entirely forgivable if guys are not all on the same page in month one because it's hit us so fast. I think the servicers and special servicers are making great efforts to push this data through correctly and quickly and start addressing forbearance requests as quickly as they can. But I do think we'll see nits in the data, and we at Trepp will do our best to try to flush those out so that users of the data can understand what they're seeing and why.
Yeah, well, it'd be interesting to see how the buy side looks at it, right? How they start modeling these things and what their assumptions will be on, success of a repayment after a forbearance or not. I assume a giant Courtyard portfolio like that, I don't know who the sponsor is. I didn't do my homework, but I assume that they've got some pretty good balance sheet behind them. But for some of the other ones, it'd be interesting to see. I will say that we have been flagging any loan that has any sort of indication that a forbearance has been requested or a modification has been requested. So even if a modification has not occurred, we do have it in our kind of data showing up as kind of quote unquote under investigation in the modification area. So there's several, I think maybe 1,700 or 1,800 or so loans so far that we were seeing. And that's only with, 35% of the data in this month. So we'll update that next week.
I'd love to see, our management and our ownership pony up to send us on a road trip, right? Getting our kicks on Route 66, reporting back to the main office, stopping at every roadside hotel we can, listening to Bob Dylan along the way, and getting a real sense of what these guys' occupancy are.
I think it'll be whatever one room is divided by the total number of rooms, because we'll be in a room, and then that'll be it.
Plus masks.
And I want that card. I want them to pony up for a convertible, right? I want to be driving down Route 66 in not even just a convertible, a Thunderbird convertible, something really throwbacky, when I can just put on some Dylan, go from hotel to hotel.
Did you must have listened to a lot of Allman Brothers today. You're in a very nostalgic mood. There's no legroom in those cars. I need legroom.
There's no seat belts in some of them either.
No.
And no AC sometimes.
Well, Manus, you definitely are at a 2 coffee pace today. So you walked us through that a little bit slower than last week, or whenever that was, that he was coming at us fast and hard with all the data. But it's a good pivot point to introduce our guest this week, our own Lonnie Hendry. He hails from Texas, so he's a little farther afield than we are here in the Manhattan area. He specializes in valuation and appraisals, and he's an all-around smart guy on financial analysis. His 16 years experience includes a ton of stuff: property management, development, leasing, brokerage, and in his spare time, he's a professor at Texas Tech, so he doesn't have a whole lot of downtime. Thanks for joining us, Lonnie. You wrote a report that Trepp just released that examines how to value a property with the current market instability. Explain how this market dislocation impacts property values. And speak at a 2 coffee pace, please.
Yeah, I was going to say thank you for the nice introduction, and I want to thank Manus for planning my family vacation down Route 66, giving me advice on how many coffees to drink and where I can buy a nice tweed jacket at JCPenney. So this has really turned into a life-changing podcast for me, so I'm very appreciative of that. As it pertains to the market dislocation and the impact on property values, I think that's kind of a to-be-determined question, right? It depends on how long this dislocation lasts. And, I don't think there'll be a one-size-fits-all given geographic disparity and property type. But I do think that, lenders, buyers, market participants are all grappling with the question of, how has this dislocation impacted values right now? And I think we would all be short-sighted to say there's been no impact. I think that the challenge is for the marketplace to quantify what that is in the short term. And I think we'll talk through some of the things in the paper that generally give some outlines on how you could address some of those concerns.
Well, you do talk a lot in the paper about calculating property value in normal times, right? When operations are stable. So talk a little bit about that first to back us into this idea.
Yeah, so appraisal is funny because by definition, it's an opinion of value as of a specific date. So if that doesn't give you a really good sense of confidence in the result, I don't know what will. So in order to have people believe in the system, in order for the process to work, that opinion has to be based on facts. And those facts are generally comprised of factual data points over a stabilized operation or stabilized holding period of an asset or a set of assets. And so when you have a market disruption, those stabilized occupancies, revenues, expense ratios, and cap rates all become, questionable. And so in a stabilized market, you're looking for what are the market norms? What's the market occupancy under prudent management, assuming that all properties are operating without any type of duress, and then correspondingly just go down the pro forma operating expenses, cap rates, and then the overall valuation. And I think in this instance, not only have those things been challenged with this pandemic, but also on the lending side, you see lenders requiring additional reserve for replacement and upfront principal and interest reserves, which detrimentally impact the buyer's purchasing power and will correspond to potentially lower values.
Yeah. So Lonnie, you mentioned a lot of things there, and obviously I like how you said opinion of value at a specific date. And if that doesn't instill confidence in you, I don't know what will. And especially now I think in stable times, there are many, many, many inputs to evaluation, right? And there's still that many inputs now, except that you can't go to a website or a data source and say, what is the time frame it's going to take for my occupancy to come back to normal, right? Or what is my cap rate, right? NOI divided by value now, given the fact that there haven't been any comparable transactions in the last, whatever it's been, month and a half or so, and not understanding that, okay, the comps in my area look pretty good, but they were a month and a half ago before all this stuff happened, right? So how do we, if you're an appraiser or you're we have a lot of banks as clients who want to go through and kind of revalue and reestimate some of their risk on their balance sheet. How do you kind of think about doing that? I mean, is there a potential way of doing that at this point with so much uncertainty?
Yeah, so I think it requires a couple of things. One, you have to have a good store of historical data to try to set what that benchmark or stabilized operational perspective is. And, Trepp is uniquely positioned because we have, a 20+ year history of property level financial data to see what is the stabilized operation in a good market and what is the stabilized operation in a bad market, right? And so that would be step one, is just having a foundational understanding of what those markets look like. I think step two is a little bit more complicated depending on the route that you choose. You have a couple of options. I think option one would be that you treat this as a short-term proposition and say, we're going to still value the property as stabilized, but we're going to attribute some form of economic obsolescence to this short-term, downturn in the marketplace. The second approach would be to do a blend of a direct cap, single year's net operating income divided by a cap rate with a discounted cash flow analysis, where you look at maybe the first couple of periods on that discounted cash flow being very negatively impacted by the loss in revenue and corresponding cash flow, and then ramping up to a stabilized operation over the remainder of the holding period. So a blend of those is what I would project the market probably is in the midst of doing right now.
Yeah. This is one of our nerdier podcasts, by the way, Martha, and I love it.
I was going to say there's a lot of formulas in his paper, so tread lightly.
A lot of nerds on this call right now.
Let me jump in for a second.
Let's hear
this
it.
question, Lonnie. You've been at the table. This is not your first rodeo when it comes to negotiations between different parties in terms of what a valuation is and so forth. What's really unprecedented, in addition to the lack of data, is that every side of the equation right now is getting squeezed, right? If you're a state or a locality, you're seeing a drop in revenue, so you're loath to cut breaks to those that could pay you something in terms of tax revenue, property tax revenue, and so forth. If you're the borrower, you're getting squeezed by tenants defaulting or choosing not to pay, or lack of demand in the case of hotels. I know this is unprecedented and you've never seen this before, but put us in that room and what do you think happens, when negotiations start? Is it going to be, everybody let's get together and hammer this thing out, or is this going to be incredibly contentious?
Yeah, so I think that's a valid question, and I think that's what a lot of municipalities at the county level or state level are going to try to balance, because to your point, most of those jurisdictions rely on a combination of local state income tax, sales tax revenue, and property tax revenue. And you can make the case that with unemployment the way it is now, that state tax income tax revenue is going to be considerably less. The sales tax revenue is going to be less, and then property values could potentially be less. Where it gets tricky for appraisers is, after the savings and loans crisis in the late 1980s, the Appraisal Foundation was formed, and this concept of the Uniform Standard of Professional Appraisal Practice was put into play, which makes appraisers bound to those USPAP standards. So regardless of whatever economic impact or negative impact there could be to a local municipality, the appraiser's job is to be a fiduciary only to their value based on the data that's available. And so I think in context, the appraiser still has to have some basis of fact in how they arrived at their value. But I also think that this is an unprecedented, event to where you basically have a total market collapse across most asset types across the nation. And so, logic has to come in as well to say, nobody really knows what the answer is in terms of what that stabilized market is.
How do you predict appraisers will defend valuations in the absence of this data?
So I think that kind of beckons back to having that foundational, history of data. I mean, at this point, we've had some other economic downturns, maybe not at the pace that this has gone down, or maybe even at the scale. But if you look back at the Great Recession, there was basically no liquidity in the market at that point. So it's a little bit of a different challenge, but very similar in the fact that tenants were getting squeezed, landlords were getting squeezed, local governments were getting squeezed. And so I think Trepp is uniquely positioned to basically create an economic obsolescence or a value loss index based on those previous historical disruptions in the market, and looking forward at how that would apply to this pandemic.
Yeah, and we may need to switch it now, meaning that historically in that, great financial crisis, Great Recession, whatever you want to call it, NOIs dropped, incomes dropped 10, 15, 8%, depending on where you were, and values dropped 30 or 40%, right? In this case, we might be in reverse, because the fact that there's so much stimulus in the market, rates are at all-time lows, and there aren't many transactions happening, there may be the case to be made that even though my NOI dropped by 30%, my value is still, my value has not dropped by 30%. Maybe it's dropped by 10 because this is still a good place to park money for the long term. Let me ask you a different question, Lonnie. We Northeasterners here have been holed up in our little hovels for what, like
8 weeks,
6 years now or so.
Yeah.
Give us a sense of the vibe in Texas in general. Like, are people staying home? Are they wearing masks? Are people out and about? Like, what's the feeling down there?
So Texas is uniquely positioned because we used to be our own sovereign nation. And so Texas kind of beats to its own drum, right? And so, we're a very business friendly state. We're very loyal to our state. If you talk bad about Texas to a Texan, their face will get red. Their adrenaline goes up. It's been scientifically proven. And so, we definitely want to be the leaders of the pack. And so I think you can see that in the way we're handling this here. Our governor has actually created some executive orders that overrule some of the local municipal elected officials that have come in at the city council level or at the mayor level and said, you have to wear a mask. The stay-at-home orders have been extended through June, and the governor's effectively rendered those powerless with his executive orders and said, it's time to get back to business. So I think, generally speaking, Texas has been pretty optimistic about reopening. We've had a fairly, successful reopening of restaurants and retail centers and some of the other, more, client-focused retail endeavors at a pace of 25% occupancy. I think they're about to ramp that up to 50%. And so I think, generally speaking, Texas has been pretty proactive on that front.
And I heard you say the other day that they're trying to woo our friend Elon Musk to come down after Elon was in a battle with whatever it was, Alameda County or
California, yeah.
In California he wants to start doing business again. All of his competitors are building cars in Detroit.
Open his factory.
And he's like, I'm going to open my factory by hook or by crook.
Yeah, so Texas has had, some version of a business enterprise fund for some time now. So we've kind of fancied ourselves as stealing as many businesses as we can from California and New York. And when someone presents it as an opportunity, we definitely don't wait to seize that. And so there was actually a county judge in Hidalgo County down south in Texas that sent a letter to Elon Musk saying that Hidalgo was very friendly, would be very accommodating to Tesla and its operations, and had good relationships across the border in Mexico with other manufacturers of automobiles. And so, hopefully for Texas's sake, those were real threats from Elon, and we can land Tesla here in Texas.
Right. All those leaders in California and other Northeast states are all bemoaning the fact that all their exes are now in Texas.
Oh, man. That was rough.
Yeah. All right.
Martha,
and
what's next?
On that, we pivot again. Trepp also released its data for the commercial mortgage investments held by life insurance companies, showing a negative 1% return in the first quarter. Now, no loans in this index were delinquent. So what would you be concerned about here, Joe?
Yeah, so this is the first time that Trepp is releasing this index study. It's Life Comps. It's been around for, I think, something like 20 plus years. Tracks the performance of commercial real estate loans on balance sheet at life insurance companies. So it's price appreciation and also income return. And the 12-month return on most of these property types was in the 4.5% to 5% area, even with a negative quarter. But I would say that, we're only getting the reflection of 1 month's worth of stress in this data. So I think the second quarter 2020 study will tell us a lot about, not only how much income are we missing out on, but also where the insurance companies are marking these loans. So insurance companies classically, I think it's true, and I think sometimes it's just the reputation, but they are main on main, Class A, stabilized property type lenders. So these are kind of the lowest risk CRE assets out there. So for them to have a negative return in just one bad month, it may tell us something is going to be even worse next quarter. But, you never know. I mean, they have all of the flexibility as a balance sheet lender to work with their borrowers on, workouts and forbearances and extensions and everything else like that. We're always talking about it in CMBS, but it's hard to do that stuff in CMBS because there's so many strictures of the structure. That's not bad. Whereas here they have a loan document and a relationship manager, and they can call up the borrower and say, how do we work this out? Right. So I do think in general, the balance sheet lenders will fare better here, most likely.
Okay, let's look at CLO market. We saw that the Fed revised its TALF program to include a broader range of leverage loans. Manis, is this going to be enough to overcome some of the hurdles in that market?
Honestly, it probably plays into what we've been saying about TALF for CMBS in the past, that it was a great tool and a very powerful tool 12 years ago, 10 years ago, when it was implemented to break through the clogging of the arteries that was illiquidity and lack of transparency. In this case, there's only so much you can do, right? No amount of pledging to buy bonds is going to put a guy in a hotel or a guy in a movie theater seat or on a plane, right? I just think that there's only so far something like this can go. And in some ways you do have kind of that moral hazard if they miscalculate and they take credits on that are kind of dead credits walking, that they revive from companies that probably would have not survived even without the COVID problems. You have that issue. I think there's some of that in CMBS too, that there's loans out there that they're saying, we want a lifeline for COVID, but even before that lifeline was extended or out there, they were already less than a 1.0 debt service coverage ratio. So you do have this potential moral hazard out there, but at the end of the day, it's all about, do people get back on cruise lines, airplanes, go to movie theaters, restaurants? I mean, that is such, between that and oil and gas, it is such a big chunk of the leveraged loan market that, if we get a very soft recovery, the CLO problems will persist.
Just back to the TALF thing for one quick second. I did read something recently. I forget what, they have so many programs out there right now, I can't keep track of them, but there was, maybe it was the sub-investment grade corporate debt facility that they set up that, I don't know if it was that one, it was one of them where they haven't actually lent any money or bought anything, but the market recovered because they made the statement that they would support it. So there is a little bit of that psychological aspect to all of these things.
Right.
Even if TALF doesn't actually buy anything, the fact that there's that support, that safety net there, makes people more willing to jump in and support the prices.
The other side of the coin is, United had to pull a deal this week. It was supposed to be securitized by, a fleet of planes. The planes were a little bit older. I think they were 17 years old. But it was a type of securitization that, in the past would have just kind of sailed through. They had to pull the deal because it turns out that they were going to have to sell that at yields of 11% or up. So they had to pull it. So that comes back to the whole notion of if you don't have people, if you're not expecting people to get on your planes and have revenue, supporting them and so forth, it's going to be a challenge. Even though this was collateralized and part of the disdain was the age of the fleet, I have to believe that there was some stigma to the airline element of that just kept pushing yields higher and higher.
We talk about culture. About 70% of the colleges say they'll be in session this fall. So the question about college sports, an important part of our culture, specifically football, is something that's up in the air. An SI article, Sports Illustrated, came out with an article that said the commissioners from the conference are way more optimistic today than they were about 2 weeks ago about a 2020 season. So here's your chance. What do you think the 2020 season looks like? Joe, Manus, Lonnie?
Well, let me start with, if I was at Rutgers, I would be inflating my COVID numbers so high that I could never put a football team on that field ever again, right? Considering their performance for the last 4 or 5 years, I would just say, no, we're 10 times the national average here. We can't put a football team out there, and just declare victory. Say, well, we would have gone to a bowl game this year had we only played. We would have beaten Michigan. We would have beaten Ohio State. We would have beaten Wisconsin, and just drop the mic and declare victory.
Wow. Hard on the New Jerseyans, huh?
Very.
How about our Texas Tech buddy? Because I can't really talk as a Fordham guy. I don't really have much to say about football.
Well, I would say, football really drives the revenue for the remainder of the sports programs. And so this is kind of the lifeblood of college athletics beyond just football. So you have the college football season, and then the NCAA tournament, and the men's basketball and women's basketball. Those are the revenue drivers for all the other non-revenue sports. And so if they don't have a season, that's going to be very detrimental for all those other sports. So I think we would all say we hope there's a season.
Oh, please. Let's hope. I was actually thinking there may be some real money to be made in the mannequin business, because I keep reading these articles about, don't laugh. I keep reading these articles about how the NFL, if they're going to have empty stadiums, they may use like stand-ins, and they're doing it in Korean baseball right now, like the cardboard cutouts, or they may do digital virtual people. But I think that could be, actually, the NFL should sell that. Be like, do you want your likeness on a mannequin on the 50-yard line? We'll sell it to you for $50, personal mannequin license for your personal seat license.
Yes. So Lonnie, you had an interesting point earlier in the week that Texas Tech, I believe, was going to have a fake opening with only some physical classes, but lots of online. Why don't you give us some details about that?
Yeah, so I don't think anything's firmly been decided, but the idea is that you open the campus and the college, but under restrictions to where you don't have obviously everyone in the same classroom. You have to meet the social distancing guidelines, but then also you don't have a full load of on-campus student classes. So there's a combination of, face-to-face at a very limited scale, maybe one class per, 5-class load if you're a student. And then the rest, delivered online. And so I think, we're entering a new normal, as Martha said earlier, and it doesn't just apply to real estate. It applies pretty much across the spectrum. So I think from a learning environment all the way through, it's going to be very interesting to see how people adapt to the new use of technology as mainstream, education.
Right. I actually think that September is the breaking point for this whole thing, because by that time, everybody in America who has children of school age are going to say, I don't care what's going on. I need these kids to go back to school. right? And not just for the sanity purpose, like, yes, mostly for the sanity purpose, but also because they had fake school for 3 months or whatever it's been, March, April, May, June, 4 months last year. And now we're going to start whatever it is, 4th grade, and they haven't even learned how to do whatever they were supposed to do in 3rd grade yet, right? So there has to be a point where we bite the bullet here.
I do believe, if I heard this correctly, that the University of California state system had announced that there will be no in-person classes in the fall. I could be wrong there. I saw a headline.
Yeah, I saw the same one. So Lonnie, you teach a lot more than I do, but I do also teach a class. And you do more online teaching anyway, right? Did you, like, what was your feeling on switching from in-person to online? Like, do you get the same level of engagement, and do you think it's the same education? I guess you can't really answer this question as a professor. You have to say yes to this question, right? We may have to cut this.
He can't incriminate himself.
I think it changes the dynamic, right? But I would say this generation is uniquely prepared for that shift because they've grown up with technology, their entire life. And so I don't think it's as detrimental or, earth-shattering for this subset of students at this point as it maybe would have been during our time in college, where, technology like this just would have been very cutting edge or new. This is kind of the norm. People have been FaceTiming for some time. They keep in touch with their family and friends that way. They do TikTok, they do YouTube. This is all part of the culture now.
Yeah, maybe I'm being self-centered because when it happened at Fordham, it was just, for me, I get so much, energy and enjoyment of being in the class and messing with the kids and asking them questions and kind of talking with them and all that other stuff. And that was gone, right? And that was a tough blow. I mean, we powered through all the material, and there were a lot fewer, Joe McBride life lessons.
I would say the same. Like there was a lot less discussion around my flat bill baseball cap and my Michael Jordan shoes because it wasn't in front of them like it would be if I were in the classroom. And so I definitely miss the interaction. But if this is what we're dealt with right now or what we're dealt to deal with, I think we just have to make the best of it and still try to deliver education and move the needle, even if it's in a little bit different delivery method.
So I think you actually talked about student housing a little bit in that report we talked about. I mean, again, nobody knows the answer, right? But this thing has got to be getting killed, especially if we don't go back in September.
I think they're very nervous right now. They probably have a lot of students and parents on the hook for this school year, even if there is no school, due to the fact that they make them sign up essentially, a semester and a half in advance. I think that puts them in a precarious spot, though, because are you really going to force people to pay rent when they're not living there during a pandemic? Or are the lenders and or servicers going to work with the borrowers if they don't make people pay? And so I think, that's an asset class from an appraisal perspective, from just a transactional perspective that's hanging on a cliff with no clear answers at this point.
So you're on the front lines these days at Trepp, and talking to prospects and clients and stuff like that. Are you seeing a lot of, like, what are you seeing, I guess? Because we do have a lot of people hitting our website. I mean, what are people looking at? What are they looking for? Is it distressed asset guys? Like, give us a sense of that.
Yeah, so I think the distressed market, I mean, the one differentiator from this downturn to maybe some others is there's a lot of dry powder on the sidelines, and folks have been waiting for this type of disruption. And so I think from a client perspective, what we've seen is a lot of folks looking for value in stable markets where they think the asset values will come back more quickly. And so lodging in really good markets where they have a track history of good performance, I think people are seeking those out. I think multifamily, for some folks, is actually going to become a buy opportunity, where for the last 10 years it hasn't, because it's been kind of overheated from a price standpoint. They've had multiple years of successive rent growth and cap rate compression. And so those have been kind of elevated to prices where a lot of investors couldn't get their yield. And now maybe there's an opportunity to come in and reset that basis.
Yeah, I think that you're absolutely right, Lonnie. And I think that we started off the call with talking about that Mandalay Bay pricing and how narrow those spreads were, considering how much disruption we've had. And I think that the dry powder has a lot to do with that kind of, to me, shockingly tight level of pricing that they were able to execute at.
Well, we talked a lot about student housing, and I know we're putting out a report on student housing in the coming days. So it's an area of concern before COVID, and now it's definitely an area of concern. So we'll probably talk a lot about that more next week. And with that, we'll wrap up. Thanks to Lonnie for joining us this week, and thanks to our producer and conscience, Keegan St. Ange. Join us next week as we look at what's happened during the week and how it impacts you. If you have a question and you'd like us to answer it, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire Podcast with your favorite provider. Thanks for listening, and stay well.
All right.